Hi, and let's talk about foreign currency. Let's talk about ISA 21. Now, for some of you who've come through the system, who've done the previous paper of FR, there are some aspects of foreign currency that you'll be familiar with when you come to look at SBR. But I don't want to assume too much knowledge, and I want in this quick podcast just to give you an overview, an introduction to foreign currency. Now, before I start, there's two aspects to foreign currency. There's how an individual company copes with the odd transaction in a foreign currency. And secondly, there's the group accounts aspect as to when you have an overseas subsidiary and you have to consolidate the overseas subsidiary's financial statements into the group accounts. So first of all, at the individual company stage, let's begin there. And that's where there would be some overlap with FR. The key phrase is functional currency. The key issue to understand is transactions and balances. And the key thing to remember is there will be 4 rules to apply. So what do I mean by the functional currency? Well, let's just stop for a second. What does foreign mean? What does foreign currency mean? It simply means a currency that isn't your home, that isn't the currency which you function in on a day-to-day basis. Now, I'm sitting here in my home in St Albans. I'm sitting here in the UK. I'm sitting here having gone out and had some fish and chips and paid for it in pounds. I collect my revenue from my SBR online courses in pounds. I spend money in pounds. I function in pounds. So for me, I think of the euro and I think of the dollar as foreign currency because I first of all know my functional currency. Now, actually, that wasn't always the case. I used to live in Singapore. And when I lived in Singapore, I lived and breathed and thought in Singapore dollars. But that's another story. The first thing that a business must do is understand what its functional currency is. And strictly speaking, that functional currency has a definition. It's the currency of the primary economic environment where the entity operates. It's the currency of the primary economic environment where the entity operates. So if you're based in the UK, logically speaking, it's probably going to be sterling. Of course, the exam is in this kind of dollar world. And in the exam, you might have to explain and justify and apply how you actually determine the foreign currency, the functional currency, in order to determine which currency is foreign. And in order to determine your functional currency, we look at the primary factors. Selling price. What currency are you invoicing in? Purchase price. Wages. What currency are you paying for labor and raw materials? Regulation. What country regulates your affairs? Now, in a simple world, you're selling in dollars, you're buying in dollars, you're regulated by dollar government, and therefore dollar is your functional currency. But if your primary indicators are conflicting, if there's necessary to use judgment, we then have to consider the secondary factors. Now, these secondary factors are really trying to determine whether the entity we're looking at is autonomous and independent and capable of its own currency, or whether or not the entity is an extension of, is a subservient to an overseas entity. So we'd look at things like the level of transactions between the entity and its parent, the extent to which it's dependent on its parent for cash flows and things like that. And if we come to the conclusion that the entity we're looking at is dependent on its parent company, that all the transactions are with the parent company, that it's a direct extension of the parent company, then the functional currency will be that of the parent company, even if it's in another world. Oh, and you can see how we ramble on. You can see how a simple idea can end up being tested and tested in a practical situation. So that's the first aspect, the individual company stage. We need to determine the functional currency. But then we move on to the accounting rules for determining how we deal with foreign currency transactions. And there are 4 rules. I need to show this to you. I mean, this has a limited effectiveness on a podcast. But the 4 rules are, because I can't work any numbers with you, if you have a transaction in a foreign currency, it needs to be translated into your functional currency spot rate. Rule 1, foreign currency transactions, translate them at spot rate. Rule 2, monetary balances, debtors, creditors, cash, loans. If at the year end, you've got some euros, euro debtors, euro loans, euro notes, euros, whatever, monetary items, don't have them at the historic rate. You're doing the balance sheet today. Retranslate at the closing rate. Retranslate at the closing rate. Monetary items are retranslated at the closing rate at the year end. Now, rule number 3, you are, of course, going to have exchange differences. You're going to be throwing up exchange differences because all transactions are going through at spot, and then year-end monetary balances are at closing. Exchange differences go to profit. Exchange differences go to the income statement at the individual company stage. Now, rule number 4 relates to foreign currency, non-monetary items. So if you buy some land overseas, yeah, don't retranslate it, leave it. If you bought some assets overseas, some land and buildings that some plant and machinery that you've paid for in a foreign currency, record the transaction at the spot rate, but the asset itself, the non-monetary asset, like inventory, like land, is not retranslated at the closing rate, it's left alone. So those are the 4 rules at the individual company stage. And of course, we need to do examples, we need to get our hands dirty. The idea here of this podcast is just to give you a bit of a revision, just to give you a bit of an overview, just to give you a bit of a tease, if you like. And obviously on my online SBR course, we practice. We deal with questions, we deal with examples. I can show you how those numbers work through the medium of video, through the medium of, engaging with you in that way. But thank you very much for listening. I have been talking about the individual company stage. There's another story about how we deal with foreign currency at group accounts. But for now, let's keep it short. Let's keep it sweet. We've been talking about the individual company stage. Thank you very much.